Good evening. Please come to this wonderful IFRS 16 Ind AS 116. Short-term leases. We are right now doing accounting. So today you have to do a lot of accounting. A short-term lease is defined as a lease that at the commencement date has a lease term of 12 months or less. There is an optional exemption here. If the lease is of short term, then you need not apply the normal detailed accounting as we have discussed for leases in the books of lessee. This exemption is only for the lessee. This exemption is not for the lessor. So a lease that contains a purchase option cannot be classified as a short-term lease. So there is a note which says if the lease contains a purchase option to buy, then it can't be called as a short-term lease. For the purpose of definition of a short-term lease, the lease terms should be determined under the general requirement. Now, very important, tick mark this paragraph. Consequently, lessees will need to assess the effect of extension and termination option. Suppose lease term is for 6 months, but there is an option to extend for 2 more years, and this option is certain to be exercised. This option is certain to be exercised. What would be the lease term? In that case, the lease term will be 6 months and plus 2 years. You can extend it for 2 more years. So my lease term will become 2.5 years. Is it a short-term lease? The answer is no. Similarly, the lease term is for 2.5 years, and after the 6 months there is an option to terminate. But it is reasonably certain that termination option will not be exercised. What is the nature of lease? Short-term or not a short-term lease? Not a short-term lease, because then the lease will go for more than 6 months. Note that the prohibition on a lease containing a purchase option being classified as short-term lease applies for any lease containing a purchase option. So if a lease contains a purchase option, the standard simply says you can't use short-term lease exemption. Okay, irrespective of the probability that the option will be exercised. There is no restriction on qualification as a short-term lease based on the value of the underlying asset or the amount of the consideration paid. So if it is a short-term lease, you can take the exemption. Then in that case, you need not look at the value of the asset. Okay, so if you take suppose an aircraft for 3 months on lease, the aircraft may be very expensive, but it is only for 3 months. You can choose this exemption of short-term leases. This exemption is available for high value items that are leased for a short term. So if it is for short term, then don't look at the value. But if there is an option to purchase, it can't be treated as short term lease. If there are extension or termination option, then those options will be considered in determination of whether the lease is a short term lease or not. Then election is to be made on a class by class basis. The election to take the recognition exemption for short-term lease is required to be made by class of underlying asset to which the right of use relates. That means if you want to take exemption for short-term lease, then it has to be for the entire class of the underlying asset. So if there are 10 aircrafts you have taken on lease, short-term lease, and then you cannot decide that this 5 I will take the exemption and this 5 I will not take exemption. Not allowed. Then you have to apply the same principle for all the aircrafts. Okay. If all of them are for less than a year, then you have to follow the same treatment. This is applicable for short-term leases. That is where the maturity is less than 12 months. A class of underlying asset is a group of underlying asset of a similar nature and used in the entity's operations. Now some more examples. Consider an entity that has leased several items of office equipment, some for less than 12 months and some for more than 12 months, with none containing the purchase option. Purchase option is not there, because if there is a purchase option, then you can't treat it as short-term lease. Assuming that the item of office equipment are all considered to be of the same class, if the entity wishes to use the short-term lease exemption, it must apply the exemption for all the leases with 12 months or less. All office equipment whose lease term is less than 12 months, because it is one class of asset, short-term lease exemption would be applied for all. The lessee with terms, the lease with terms longer than 12 months, of course, will be accounted as per general recognition and measurement requirement. For that, we don't have an option. There we have to apply this standard. Next paragraph is impact of lease modification. If a lessee account for short-term leases availing exemption, it should consider the lease to be a new lease for the purpose of the standard if there is a lease modification. We will discuss lease modification after some time. That is change in the scope of the lease. That is lease modification. You add one more asset in the lease. You reduce something in the existing contract. That is called lease modification. Like first you took this property, this area you took on lease, which was 2000 square feet, and then later on you took that adjacent office also, which was 500 square foot. So this can be an example of lease modification. Okay, maybe the earlier you had entered into a contract for 6 months and then you modified it for another 12 months plus 12 months. So this can be an example of lease modification. Okay, so if there is a lease modification, it should consider the lease to be a new lease for the purpose of this standard. We'll discuss about this in a while in detail. If there is a lease modification or if there is a change in the lease term, for example, the lessee exercises an option not previously included in its determination of lease term. So once this event occur, you treat it as a new lease. Again check whether the short-term exemption is valid or not. And then maybe you will have to change the method of accounting itself from a short-term lease to a normal way of accounting for leases. Next line, in the context of short-term lease, any lease modification and specifically any change in the lease term will be considered a new lease, which will need to be reassessed to determine if it qualifies for the short-term lease exemption. Okay, that means after the modification you have to see whether it still needs to be given short-term lease exemption or whether you will follow the regular provision of the standard for leases in the books of lessee. Okay, right now we are in the books of lessee. So all this discussion is taking place in the books of lessee. Short-term lease exemption is available only for lessee. So this is first exemption, short-term. Second exemption is low value item. So next exemption is called low value asset exemption. These are the two exemptions in this standard where you will not follow the normal accounting of present value and then dividing the payment into interest, principal, depreciation. Those are not applicable in two situations. One, either it is a short-term lease or it's a low value item. So now my topic is low value asset, which are also exempted. But then the question is, what is low value asset? The standard does not define what is a low value asset. This standard is not defining what is a low value asset. So it has left to your judgment. But in some other context, they had discussed about this low value item, and they had come to a decision that it may be US dollar 5,000 or less may be treated as a low value item. So leases of underlying asset with a value when new, underline when new. So whether you have to check the asset low value or not is first price. That is when it is new, what is its value? Okay. So a car, for example, when you purchase it new is 10 lakhs or 1 million. Okay. So you have to see what is the value of the car when it was new, 10 lakh. Now you check whether you will treat 10 lakh as a low value or not. So when it is new, what is its value and whether that value will be qualified as a low value item or not. Not in the current state. In order to example of no value underlying asset can include tablets and personal computers, then small items of furniture, telephones. Assessment independent of the size or nature of the lessee. So while evaluating a low value item, it should be independent of the size or nature of the lessee. Assessment as to whether underlying asset is of low value is performed on an absolute basis, not on relative basis, whose meaning is printed here. See the fourth line on the screen. What is absolute basis? Accordingly, different lessees are expected to reach the same conclusion about whether a particular underlying asset is of low value. Okay. So a car may not be a low value item for me, then it is not a low value item for you also, although you are 10 times richer than me, but for both of us it is same. Yes or no? Why? You are not rich. Present value I am talking about. Then yes or no? Leases of low value asset qualify for the accounting treatment of the standard, regardless of whether those leases are material to the lessee. The assessment is not affected by size, nature and circumstances of the lessee. So don't waste too much time on this. They will mention in the problem or in the case study, company treats this item as a low value item. And what you will do? You have an option. Either you can take the exemption and then you will apportion the lease expenses on straight line basis or any other basis which is more suitable, or you can decide to apply the standard. Okay. But they are giving you the guideline how to identify low value item. The value of the underlying asset should be assessed based on the value of the asset when it is new, regardless of the age of the asset being leased. So whether it is low value or not, look at the first price or look at the price when the asset was new. A lease of the underlying asset does not qualify as a lease of a low value asset if the nature of the asset is such that when new the asset is typically not of low value. So you can't treat an aircraft as a low value asset. Okay. You can't treat a Mercedes car as a low value asset. For example, leases of car would not qualify as a low value asset because a new car typically would not be of low value. Basically, the absolute means in rupees term or in dollar term, like $5,000 is an absolute term. Now, what they have done in this standard, now one company is Reliance Industries Limited, one company is Small AS Foundation. Now, for them, a Mercedes car is a low value item. But for me, even my I-20 is a high value item. But then they are saying if it is a low value item, it is low value for both, without looking at the size, nature of the entity. See, basically, the idea is that you should avoid unnecessary accounting complication for small value items. Now, that some degree of subjectivity, they have left it to you. Then what the auditors are doing? You will also accept. What will shareholder do to your next fees? See, this is a principle based standard, so of course you will apply your judgment. Sometimes the standard does not go into too much of complexities, okay? Finally, entities will apply their own judgment only, that is what I know. Okay. Reliance Industries might treat a small computer as a low value item, like this one. But I will not treat it as a low value item. That is the difference. And then you can't go to two companies and tell them this is what they are doing. They can always say that no, this is my stand, that is their stand. And legally or any other way, you can't make them change their accounting policies. Now here you underline, the exemption for lease of low value asset is available on a lease by lease basis. Now here they have not mentioned about class of asset. Keep in mind, for short-term leases, in terms of short-term leases, all class of asset you will apply the same principle, but for low value item, this you will analyze on lease by lease basis. There is a small difference in the treatment of short-term lease and low value item exemption. For example, now see this case study, there is hospital which entered into a rental contract for a large number of hospital beds. Each bed within the contract constitutes an identified underlying asset, and the other condition for identification of a lease are met. So first we have to see whether it is a lease. Yes, that the question has cleared. The value of individual hospital bed would be considered to be low, even though the contract for all the beds is not. If I look at one single bed, it may just cost say few thousand rupees. But if I look at all the beds together, then it is a high value item. So will you take exemption? Yes or no? Read the first line, lease by lease. So the value of an individual bed would be considered to be low even though the contract for all the beds is not. The condition of the standard are met. The hospital can benefit from the use of individual bed together. So what we have to see whether this asset can be used independently. It is not interrelated or highly dependent on other asset with other resources that are already available, and each individual bed does not need other asset to make it functional for the patients. Consequently, each bed qualifies as a low value asset, and the entity can elect to apply the low value asset exemption to all of the beds under the contract. But there are 100 beds, but each bed has a low value, na? And they are independent. One contract, doesn't matter, substance over form. Portfolio application is an option. One option is you can take a value, you can assume low value for each bed and expense it out. Each bed. Contract is only a form, one has to see the substance. In one contract also, now let us go back to second lecture. In one contract we have suppose a car, a TV, a furniture. But if there are different asset. They are capable of used independently and they are not dependent on each other. Therefore, we will have to do, there are three components of the lease, right? So here also we have three beds. Now one question is, can we use portfolio approach? You can, you are allowed. Can we use this exemption of individual asset exemption? Yes, you can do. So either way you can do the accounting. Yes, you are having an option here. Option means you can expense it out because you will treat each asset as one lease component. Okay. There will be so much of comparison while comparing two different. Of course, you'll have to give notes, na? What accounting policy you have used. See, as in any case, right now we can't compare two financial statements. One follows SLM, one follows WDV method. But this is given so that you can reduce your accounting effort. Okay. Assets that are highly dependent on or highly interrelated with other assets do not qualify as low value item. Okay. So lease will qualify for this exemption only if the asset, the lessee can benefit from the use of underlying asset on its own or together with other resources that are readily available to the lessee. Like this previous example, each bed can be used on its own and the underlying asset is not highly dependent on or highly interrelated with other asset. So if you buy 100, you take 100 beds on lease, each of them can be used independently, and if they are of low value item, you can apply this exemption for all the low value items. Now assets that are highly dependent on or highly interrelated with other asset do not qualify as a low value asset. Therefore, if either the lessee cannot benefit from the underlying asset on its own or the underlying asset is highly dependent, the recognition exemption for low value asset cannot be applied for individual asset. Then what you will have to do? You have to take all the assets together, and if all the assets put together meets the low value criteria, then you can apply the low value asset exemption, otherwise not. Now one example you will find in your notes, which I have simplified on the screen. Suppose there is a mainframe server and it requires individual modules that increase the storage capacity of the mainframe server. Mainframe server, you can add individual modules to increase the storage capacity of that mainframe server. Now here you will see these individual modules cannot operate independently. All these individual modules are connected to server, then they will produce the desired result. Can we take the benefit of low value exemption here? The answer is no. If all of them put together does not qualify as low value item. So that is one interesting example. Although each module within the server, if considered individually, might be an asset of low value, the leases of modules within the server do not, underline, do not qualify as lease of low value asset because each module is highly interrelated with other parts of the server. So you can be asked a question on this also. They will give you a case study and then you have to answer whether low value asset exemption is available or not. Then they have clarified some more point. Head leases do not qualify as low value asset. What is head lease? Now this is one entity, let us call it A Limited. Okay. There is another entity X Limited, another entity Y. A Limited takes an asset on lease from A. A Limited gives that asset on lease to Y. So this we will call head lease, and this we will call sublease. So if the lessee subleases an asset or expects to sublease an asset, the head lease does not qualify as a lease of low value asset. So then this you can't classify as a low value asset. The asset which you have subleased or you are expecting to sublease, then you can't take the benefit of low value asset exemption here. Keep this point in mind, it will come in sublease accounting also. The standard as sublease accounting also in the syllabus. How will you do the accounting of that? We will discuss afterwards. This we have discussed. Recognition of lease payment for short-term leases and of low value items. Now whether it is short-term lease or low value item, the accounting is very simple. You will recognize the lease payment associated with those leases as an expense on straight line basis over the lease term or another systematic basis if that basis is more representative of the pattern of the lessee's benefit. So what do you mean by straight line basis? You will add all the payments that you are going to make over that period and divide by n. N means number of months or year. Is it right? But they have said any another systematic basis if that basis is more representative of the lessee's benefit. Okay. If you can justify any other basis, like you can say my production is more in January, less in February, less in March, then maybe you can follow a different pattern so that it will be matching of revenue and expense. But mostly what you will find in practice, straight line. People normally go with simple option. Now there is a small question here. For example, this is not a question, example. If the lease payment of an asset are based on actual uses of the asset or are revised periodically to reflect the efficiency of the asset or current market rates, the amount actually payable may be an appropriate measure. The lease payment to be spread on a straight line or other systematic basis are after deduction of any lease incentive. Even if there is a lease incentive for short-term leases also, my lease payment will be accounted after deducting lease incentive. And sometime in the first paragraph, if the lease rentals will get revised later, okay, after the review, that time we will recognize it as an expense. The term lease term includes any rent-free period also. Like for example, suppose it is a 4-year lease, but low value item. First year free, and then you pay 4 lakh for 3 years. How will you do the accounting? Total 12 divided by 4 every year, assuming we are following straight line method. So 12 divided by 4, 3 will be recognized each year, even though it is a rent-free period. Now one numerical question will come. Very easy, you will be able to solve. Entity A leases office equipment for 5 years. The total value of the equipment when new is 5,000 currency unit. And now see, they will give you this information to you in the question, determined by entity A to be a low value. Entity A elects to apply the low value asset exemption. Lease payments are as follows. Year 1 rent free period nil. 2 and 3 1750 per year, 1750 per year. 4 and 5 1500. In addition, the lessor provides a lease incentive with a value of Cu 500. The lessee's benefit under the lease arises on a straight line basis over the full lease term. So now what you'll have to do, suppose they ask you how will you recognize the lease expenses. So first point is that we are going to take the advantage of low value asset exemption. We will calculate the total rent minus lease incentive divide by number of years, that is 5. So can you tell me without reading the answer how much amount you will recognize each year? 1000? Have you seen the answer? No, that's better. So now you see the total lease payment. First year is 0, don't consider. Then 1750 into 2, 1500 into 2 minus 500 lease incentive. So this net amount comes to 6000. Lease term 5 year, divide by 5. So every year 1200 will be recognized as expense. One more question. Period over which lease incentive should be recognized. These are all, you can say, very detailed technical questions. Entity B leases an office equipment for 5 years. The total value of the equipment when new is 5000 currency unit, determined by entity B to be of a low value, and they have decided to use low value asset exemption also. The lease includes a clause requiring lease payment to be repriced to market rates part way through the lease term. So what is the clause in this lease arrangement? That lease payment will be repriced. That means they will revise. They may revise according to market rate part way through the lease term, somewhere during the lease period. If the market condition changes, they might revise the lease payment. Then the lessor grants an incentive to entity B to enter into lease arrangement. So think like the previous problem only. You got 500 as lease incentive. So the question is, over which period should the lease incentive be recognized? That is, should it be recognized over the whole lease term? Like in this example, 5 year? Yeah, 5 year. Or should it be recognized over the period up to the repricing of the lease payment to the market rates? Suppose lease will be repriced after 3 years. So should we recognize lease incentive over 5 year or when it will be repriced? So this question was posed before the IFRS interpretation committee also, and they have come to the conclusion that lease incentive will be recognized over the lease term. That means in our example, full 5 year. So whatever calculation you did earlier will be applicable even if there is a repricing clause in the lease arrangement. It should be recognized on SLM unless other systematic basis is more representative of the time pattern of entities B's benefit from the use of the leased asset. IFRS interpretation committee confirmed that the general requirement for spreading lease incentive over the entire lease term should apply. Lessee's involvement with the underlying asset before the commencement date. So sometimes lessee might incur expenditure, okay, like lease improvement before the commencement date. What about such expenditure? P&L account. If it give rise to an asset, add to lease. If it is, let us see. So multiple answers are given by student. One says expense, one said as to lease asset, but it can be treated as another asset also under other standard. Okay. So be careful here because we are going to get a question on this. Cost of the lessee relating to construction or design of the underlying asset. For some leases, the underlying asset may need to be constructed or redesigned for use by the lessee. Okay. Depending upon the terms and condition of the contract, a lessee may be required to make payment relating to construction or design of the asset. If a lessee incurs costs relating to construction or design of the underlying asset, the lessee should account for those costs applying other standards. So if the lessee incurs the cost to construct an asset or design an asset so that he can use that entire leased asset, let's say you are given a building on lease. What happens then? Inside the building you may have some lease improvement, you may have furniture, etc. So then those items will be capitalized as a separate asset. Such cost, underline, do not qualify to be initial direct cost. So you had said we will add it to the lease, right of use lease asset. The answer is no. If it does not qualify as initial direct cost, they will be treated as a separate asset. They are not included within the carrying amount of the right of use asset, but rather are accounted as separate asset, assuming that recognition criteria under other standards are met. So when you are given many costs, you have to identify out of this how many would be treated as a separate asset cost, how many of them will be treated as cost towards the lease. Okay. Now what will be the initial measurement? See this small diagram. Actually this is what we have discussed in last two lectures. Okay. Initial measurement. How will you recognize lease liability? Following items you will add and take their present values. Which item we will add? Fixed payment, less incentive, penalty for termination if reasonably certain, variable payment based on either index like CPI or rate like LIBOR, expected residual value guarantees, and exercise price of purchase option if reasonably certain. Take the present value. While calculating present value, use interest rate implicit in the lease or incremental borrowing rate of the lessee. That again we'll discuss in a while. And what about the amount to be capitalized as right of use asset? This amount you will first calculate. Okay. After calculating this amount, plus you will also add any initial direct cost. Plus any initial direct cost. So initial direct cost will not come here, but it will be added to right of use asset. So asset value initially may be different from liability value. Okay. And plus in the case of the right of use asset, we may also have to add estimated cost of dismantling and restoration of the asset. Like normally if you take a building on lease for 10 years, use it for 10 years. But once 10 years are over, what will you do? Will you just leave everything and walk away? No. What will you do? You have to remove all those furniture, fixture, electrical equipment, repaint it and hand it over in the same way, the way it was handed over to you in the beginning. And that is called dismantling restoration cost. Similar to your property plant equipment standard, decommissioning liability. Is it right? So present value of the decommissioning liability, which is called in this chapter dismantling and restoration cost, will also be added to the ROU asset. Okay, right of use asset. So can the two figures be different? Yes, because this might include initial direct cost, which is not to be added in the lease liability. It may include the provision for dismantling and restoration of that asset, which is also not included in the lease liability. Okay. So now today we'll have to take some problems also. Initial measurement of the right of use asset. Right of use asset to be measured initially at cost. So the first principle is, when you start the accounting, it will be measured at cost. Okay. But this is a different standard. So here the cost calculation is not like a normal cost calculation under property, plant, equipment standard. Are you following? Here the cost will be based on first initial measurement of lease liability. Initial measurement of lease liability. That means we have discussed following 5 items you will add. The fixed payment, variable payment but subject to linked with index or rate. Then option to buy, if it is reasonably certain that you are going to buy the asset. Okay. Termination option, if it is reasonably certain that it will be paid. Guaranteed residual values minus any lease incentive. That calculation all discounted at present value. And then you will also, this we have written here, all lease payment, any lease payment made at or before the commencement date. Between inception date and commencement date also, if you have paid something, add that also. So minus lease incentive received. Okay. Less any lease incentive received, any initial direct cost incurred by the lessee, and any estimated cost to be incurred in dismantling and removing the underlying asset, restoring the site on which it is located, or restoring the underlying asset to the condition required by the terms and condition of the lease, unless these costs are incurred to produce the inventories underlying. Practically again not very important, but if they are mentioned, unless these costs are incurred to produce the inventory, in which case you will add it to the cost of inventory. The lessee incurs the obligation for those costs either at the commencement date or consequence of having used the asset during a particular period. The obligation for such costs are recognized and measured, underline applying which standard? The standard on provisions, contingent liability and contingent asset. So this provision for dismantling removal will be as per provision standard. Now what is initial direct cost? This word has come in the previous paragraph. So initial direct cost are the incremental cost of obtaining a lease. These are the costs you have incurred because you wanted to take the asset on lease. And if you are a lessor, these are the costs you incur because you want to give the asset on lease. That would not have been incurred if the lease had not been obtained, except for such cost incurred by a manufacturer or a dealer lessor in connection with a finance lease. So this exception we will see afterwards when we will come in the books of lessor. For the time being, this standard says if such initial direct costs are incurred by a manufacturer or a dealer who also gives the asset on lease, then they are not treated as initial direct cost because they are more like sales promotion expense. A manufacturer incurs such cost because he is more interested in selling the asset. Is it right? But other parties who incur such costs, they are more interested in obtaining the asset on lease or giving the asset on lease. So therefore for them the treatment would be different. And right now we are in the books of lessee. So example of any incremental cost that you know: commission, brokerage. Is it right? If you have to take this property on lease, There may be commission, brokerage, stamp duty, registration fees, legal fees. If some existing lessee is already there, then you may have to give some compensation to the existing lessee so that he will move out and you can move in. Even that is called initial direct cost. But if you install AC in this property, furniture, that is not initial direct cost, then that will be treated as a separate asset. Initial direct costs are costs incurred in negotiating and securing a lease arrangement. They exclude cost incurred by a lessee relating to construction or design of an underlying asset. So they will be treated as a separate asset. Initial measurement of lease liability. Very simple. In case if you are not using the short-term lease exemption or low value asset exemption, then you have to make a list of all the lease liability that we have discussed to be included in lease payment and compute the present value. So at the commencement date, the lease liability should be measured at the present value of lease payment. The previous lecture was dedicated to this item only, what is lease payment, and are not paid at that date. That is called lease liability. What should be the discount rate? So the standard gives you two choices. First choice is to find out the interest rate implicit in the lease. Interest rate implicit in the lease, in simple words, is called internal rate of return of the lessor. IRR of the rate of return that the lessor is going to earn from the lease arrangement. That is called IRR. So you have to identify from your IRR, from your lessor, what is the IRR. If he informs you about that, use it as a discount rate. But if he does not inform you about the interest rate implicit in the lease, then you will use the lessee's incremental borrowing rate. So most probably you have to apply this second option only. What is incremental borrowing rate? That is, if you go to the market and you take the similar loan amount, similar term, similar security, similar credit rating, how much rate of interest you would normally pay. Still in the standard they have defined what is interest rate implicit in the lease. So it means the rate of interest that causes the present value of lease payment plus unguaranteed residual value. A definition is from lessor's point of view, because this concept of unguaranteed residual value will never come in the books of lessee. It is only the lessor who may enjoy the unguaranteed residual value. Yes or no? After 3 years you return the asset to him, he will enjoy the unguaranteed residual value. So while calculating his rate of return, he considers that amount also. You return this building to him after 3 years, but then he can sell it, he can enjoy that building after 3 years. So we will also take into account unguaranteed residual value to be equal to the sum of the fair value of the underlying asset and any initial direct cost of the lessor. If I analyze the definition closely, and if you are a student of financial management also, this is what is typically called IRR. Most probably in the exam this will be given to you, and if not given to you, calculate. Is it right? So we are not going to calculate IRR in all the questions that is printed in our book. This is given, but otherwise you have to make a list of all the cash flows, find out that discount rate at which present value of this amount, which is nothing but inflow, can you see these are inflow, is equal to present value of this amount, which is nothing but outflow, because you will have to buy an asset today. That means you have to incur the fair value of that asset today, plus you have to incur the initial direct cost. So this is your investment, this is your cash flow. The discount rate that equates the two is the IRR, or technically interest rate implicit in the lease. Okay. Then your question is, what is unguaranteed residual value? Which means it has not been guaranteed. That portion of the residual value to the underlying asset, the realization of which by a lessor is not assured or is guaranteed solely by a party related to the lessor. So first is the realization of which is not assured, or it can be amount which is guaranteed by a related party of the lessor. Yesterday we had seen this concept of guaranteed residual value. That is an amount which is guaranteed by the lessee or an unrelated party that would be paid to the lessor at the end of lease term. Unguaranteed residual value, you can say mathematically total residual value minus the guaranteed residual value is equal to unguaranteed residual value. And this can be an important number practically which affect the accounting of leases, especially in the books of lessor. And if I am using that discount rate, then it will also affect the accounting in the books of lessee. Okay. Now what is incremental borrowing rate? So this is the rate of interest lessee would have to pay to borrow over a similar term. Similar term means same number of years with a similar security, means same collateral, the funds necessary to obtain the asset of a similar value to the right of use asset. So we can simply say the rate at which you can borrow from the market, assuming other factors are similar term, similar amount, similar security. Go to the bank and this you will be able to find out. Subsequent measurement. How many models this standard has permitted? 3 model. Right of use asset should be measured using cost model, fair value model, revaluation model. These two are highly theoretical. Fair value and revaluation model will be very theoretical, because here it is not a normal asset we are talking about. Here we are talking about only our right of using the asset, and for accounting purpose we are using the fair value. If I am getting a building for say 3 years and the building value appreciates, how does it matter to me as a lessee? Will I use the revaluation model? But the standard is given. So after a lot of analysis, I have personally come to the conclusion that this is very theoretical, because I have only the right of use of an asset, and therefore if the actual value of the building goes up, I need not apply this standard. But one possible interpretation why this they have given is, understand, but as I told you, for exam purpose they won't bother you with this. I have paying 6 lakh rupees rental for leasing a building, but the market value may have changed. The market value may have changed. So probably they want you to apply, check what is the market value, and then based on that you do the calculation. But again, nobody would do that, because normally the ROUA, that means right of use asset, is linked to the value of liability. And in this standard we are changing, you will see in the subsequent few paragraphs, we will change this value only when the liability changes. Otherwise the standard does not talk anywhere that you change the value when the market value of the rent changes. Is it right? So therefore, to my understanding, we can think about it more how to apply the fair value or revaluation model for right of use asset. I tried to find out also from many sources but could not get a convincing answer how this two model can be applied for right of use asset, right? So what is cost model? Cost model is you capitalize the asset initially at cost. Subsequently, you provide depreciation, or if it is intangible asset, amortization, and if required, you deduct the impairment loss also. That is called cost model. Cost minus depreciation minus impairment. But in the standard, it will also have one more adjustment in the cost, adjusted for any remeasurement of lease liability. If there is a modification in the lease, 2000 square foot building was rented earlier, now they have made it 3000 square foot. So your liability will increase. Liability will increase means your right of use of asset will also change because you are getting more asset to use now. Reverse also can happen. You had taken 2000 square foot area on lease, now you want to just take 1000 square foot. So you'll reduce the liability also and reduce the asset also. So sometimes this right of use of asset carrying amount will change because of change in the liability. What about depreciation? Over how many years you will depreciate and how will you depreciate? So this standard says use the same depreciation accounting which you have used in the property, plant and equipment standard. But there is a change here on the screen 1 and 2. Situation 1 is if the lease transfers ownership of the underlying asset to the lessee by the end of the lease term, or if the cost of the right of use asset reflects that the lessee will exercise the purchase option. So point number 1 means if it is certain or reasonably certain. Certain means you are going to get the asset after lease term. It is mentioned in the lease agreement. After 5 years, the asset will be handed over to the lessee. Or if it is reasonably certain, what is reasonably certain? After 5 years, the lessee can buy the asset for 1000 rupees, whose market value is 5000. It is reasonably certain, which means finally you will become the owner of the asset after the lease term. In that case, the asset will be depreciated from the date of commencement till the end of the useful life of the asset. Till the end of useful life. Okay. Now suppose lease term is 10 years, but useful life is 15 years. Right. So then I know that after 10 years I will become the owner and I am going to use it for 5 more years. Then I will use 15 years as a depreciation period. Then we will transfer at whatever amount is that. But for depreciation purpose, I will take now 15 years. Okay. This standard does not tell you what you will do after that date. This is what you will do because you have purchased a new asset now. Now you have become the owner. So then that standard on property, plant, equipment will apply. But for depreciation purpose, now what you will do, this standard tells you that you will take 15 years. Case 2, others. Others means suppose you are not going to become the owner after the lease term, or it is not reasonably certain that you are going to purchase the option. Then in that case, the asset will be depreciated from the date of commencement to the earlier of, lower of the two, the end of useful life of the lease term or the end of the lease term. So here I will take useful life or lease term, whichever is lower. Useful life or lease term, whichever is lower. Normally, the lease term would be lower. Normally, the lease term would be lower, but still they have given this possibility that in that case you will take lower of the two. If useful life itself gets over before the lease term, possible, because the technology is changing, demand and fashions are changing. So maybe your useful life is 9 year only, but the lease term may be 10 year. So then you will depreciate it over 9 year. Okay. And if you are certain to become the owner or reasonably certain to become the owner, then take useful life only. Take useful life only. Okay. Since you are the party who has now capitalized this asset, then there is one more standard that will apply. A lessee should apply impairment of asset standard to determine whether the right of use asset is impaired and to account for any impairment loss identified. What is impairment loss? Recoverable amount is less than carrying amount. Recoverable amount is higher of the two. Value in use and fair value less cost to sell. Okay. Again, my understanding is very few entities would apply this paragraph also. Impairment of right of use asset. You have taken building only for 3 to 4 years. So calculating fair value less cost to sell, value in use, etc. may be difficult. But anyway, you can still calculate. Next is right of use asset that relate to a class of revalued property, plant and equipment. Now here we have a choice. Investment property also, same thing. But in investment property, if you follow a particular model for owned property, you will follow the same model for right of use asset investment property. Suppose you have two investment property, owned, leased. You will follow the same model. You will follow the same model for that. But for other assets, if you are following revaluation model for owned asset, you can either follow revaluation model or cost model for the leased asset. So if I own a machine, if I lease a machine, if I use revaluation model for owned machine, I may use revaluation model or cost model for leased machine. But if I own an investment property and then I follow suppose fair value model, which is not permitted in Ind AS but permitted in IFRS, then I will follow the same model for lease property also. Again, don't waste so much time on this because I think this is going to be very theoretical. Who is going to apply fair value and revaluation model for right of use asset? Okay. Our life is already so busy with so many other activities. But this kind of paragraphs are there so that in future, once you start applying the standard, you have some scope to change the numbers. Okay, keep that in mind. Yes. Innovative accounting you can do here. For PPE, if the class of owned asset to which right of asset relate is measured using cost model, the right of use asset should also be accounted for using the cost model. If owned asset cost model, leased asset also cost model. If the owned assets are measured using revaluation model, leased asset can be measured using revaluation model or cost model. Cost model, follow cost model. But revaluation model, you can follow cost model or revaluation model. Okay. In case of investment property, cost model, revaluation model, revaluation model. subsequent measurement of right of use liability. Now see, after the commencement date, the lease liability should be measured by increasing the carrying amount to reflect the interest on the lease liability. So what you will do, every reporting or every period when you have to pay the installment, you will pass one entry, interest account debit to lease liability, being interest accrued for the period. And then whenever you make the lease payment, entry will be lease payment account debit or lease liability account debit to bank. This is similar to what you have learnt in basic accounting also. Is it right? And remeasuring the carrying amount. Now there will be situation where the carrying amount itself will have to be remeasured, especially when there are lease modifications. Lease modification, change in lease term, or earlier you had decided not to use the option, now you have decided to use the option. So any such thing which changes, that means which will change your future cash flow, will also affect your lease liability. So in that case also you have to remeasure the carrying amount and change the carrying amount of lease liability to reflect any reassessment or lease modification, or to reflect revised in substance fixed lease payment. On this we had taken two questions in the previous lecture. Do you remember? There were two questions. One was based on index and one was based on rate. So every time this index will change, our lease payment will change. Again I will calculate the present value and the difference amount will adjust in lease liability. Anytime if that LIBOR, MIBOR, which is based on which the lease rentals are based, will change, again my calculations would change. These two items can be used for variable rate, but something like some percentage of sales value will not be considered. Lease liability accounting will be always using amortized cost model under financial instrument standard. This is what they have said, amortized cost model. Interest expense will be allocated over the lease term. Measurement of lease liability at fair value after initial measurement is not permitted. So you cannot apply fair value through profit and loss account model for lease liability under this standard. This model is not allowed. Only amortized cost model is allowed. Next is amount to be recognized in profit and loss account. So which figures will be related to lease go to P&L account? One is interest expense. Okay. Unless they can be capitalized as per any other standard, like IS 23, borrowing cost. Is it right? Because lease interest in a lease is a finance cost, and therefore IS 23 may permit you to capitalize, but again chances are very rare. So interest goes to P&L account. Variable lease payment which are not in substance fixed payment, are included in the measurement of the lease liability. Not included in the measurement of lease liability will be recognized in the period in which the event or condition that triggers those payment occur. So P&L account, variable lease rental which are not part of lease liability, which we have discussed earlier also, like some 10% of sale or some similar basis. After the commencement date, if the changes to the lease payment occur, lease liability should be remeasured. Okay, like for example, change in lease term, change in the purchase option. Earlier you had decided not to purchase, so that amount was not considered. Now you may decide to purchase, so that amount can be considered. Or the area that you have taken on lease has increased or decreased, etc. On that we have 3 questions, very complicated, but you will be able to understand. So those items will be considered in the lease liability, and if the amount changes, you have to change the carrying amount of the lease liability. Where will the second effect go when you have to change the carrying amount of lease liability? Then the second effect goes to right of use asset. Okay, second effect will give in right of use asset. However, if the carrying amount of the right of use asset is reduced to 0 and there is no further reduction in the measurement of lease liability, the remaining measurement should be recognized in profit or loss. Now, very interesting, again very theoretical, but still we will discuss. Any possibilities existing, that is why it is given in the standard, but not very frequent. Suppose due to changes or modification, lease liability reduces. Now you must have learned by now that lease liability and right of use asset balance need not be same at every point of time. Only maybe initially also, if there are no direct cost, no present value of restoration liability, then initially they will match. Afterwards, lease liability accounting is interest is added, payment is deducted. Interest is added, payment is deducted. Whereas the asset is depreciated. So of course the value may not be same. Normally it has been observed that lease liability figure would be higher than the asset figure. Okay. So lease liability account debit to ROUA, right of use asset. But this amount I have to reduce by 1 lakh. This balance in the asset account itself is 80,000. So asset balance will become nil. What about the remaining 20,000? This is another area where another time when profit and loss account will be credited. So if you have to suppose reduce the liability and there is not sufficient balance in asset, then you can recognize it as a gain in profit and loss. Asset won't appear. Liability will appear. Liability will appear for the remaining period. If you have impaired the asset, now my liability is increasing. If your liability is increasing, that is for other reasons, and impairment of the asset is due to other reasons. This once again, which asset you want to recognize? One lady is asking a question. Right of use asset previously recognized is impaired. Impairment, huh? Now what happened? My liability has increased. Okay. If your liability has increased, it means you have to make more payment. Correct? If you have to make more payment, that means a second effect will also go to the asset account. So in this case, my entry will be now all that depends on the numbers. After passing this entry, you have to see, then you apply the impairment standard, and after applying the standard, lower of the two we have to take. Which lower of the two? Carrying amount, which would have been determined had we not provided the impairment loss, and second, the recoverable amount. So to that extent you can do it. Every time you cannot accept. So what you are saying is only if my recoverable amount is below this figure. But if it is higher, then we can reverse up to that. IS 36 allows reversal of impairment loss. Okay. I'm telling you, my analysis is impairment would be a very rare entry for right of use asset, unless you can't get any benefit from that asset in future. Okay. Now where are we? Remeasurement arising from a change in lease term or reassessment of purchase option. Now underline these two terms, lease term and purchase option, because we will also discuss some other aspects and the treatment is slightly different. Right now my remeasurement is arising from a change in lease term or reassessment of purchase option. How can the lease term change? Like for example, lease term is for 10 years with an option to extend it by another 5 years, means I can take it up to 15 years. So what can happen now? When we were doing the accounting here at the commencement, we thought that this option of extension will not be exercised. But then you may decide after some 7 years, you may think, no, this extension will be useful to you. Is it right? So therefore now my lease calculation will be based on 15 years. So lease term has gone up. Earlier, suppose you had an option to purchase. You thought that you are not going to purchase the asset. So that figure will not be considered in calculation. But later on you may decide to purchase. So the moment these numbers will change, your lease liability would change. So that is called remeasurement arising from change in lease term or reassessment of purchase option. The lease liability should be remeasured by discounting the revised lease payment using a underline revised discount rate. In these two cases, if your lease term changes or purchase option situation changes, what you simply do, suppose you want to revise here, again make a list of all your lease liability payment from this point to 15 year, discount it, calculate the present value. So that present value will be different from your existing carrying amount. Difference, adjust it, one effect in asset and one effect in liability. So it's not very difficult. You have to just first reach the carrying amount at this point where you want to change. Recalculate the new cash flows with revised discount rate at that point. Calculate the difference and pass the entry, either lease liability to asset or asset to lease liability, depending upon whether your lease liability is going up or down. If either there is a change in the lease term, in which the case the revised lease payment should be determined on the basis of revised lease term. So I will see what would be my lease payment during this period. If there is a change in the assessment of an option to purchase, I may decide to purchase the asset, the underlying asset, in which case the revised lease payment should be determined to reflect the change in the amount payable under the purchase option. So this is very simple. You just have to make a list of cash flows now from the date of change till the last date in that problem, and use a revised discount rate and compute the present value, compare it with the existing carrying amount. Why should we use the revised discount rate in these two cases? In which two cases we'll use the revised discount rate? When there is a change in lease term or when there is a change in purchase option. This standard normally does not allow you to use a different discount rate during the lease term. normally an entity should not reassess the discount rate during the lease term. However, the standard requires a lessee to remeasure lease liability using revised payment and revised discount rate when there is a change in the lease term or change in the assessment of whether the lessee is reasonably certain to exercise the option to purchase the underlying asset in these two cases. And what is the reason they have given in the standard? Why we need to change the discount rate when there is a change in the lease term or the decision relating to purchasing the asset? The economics of the lease have changed. What has changed? The economics. Means all your decision making issues. Okay. All the decision making issues are called economics of leases have changed. All your analysis of benefit cost, you must have done that analysis at the back of your mind. That if I increase the lease term, what will happen? If I use repurchase option, what will happen? Then the standard says since the economics of the lease have changed and it is appropriate to reassess the discount rate to be consistent with the change in the lease payment included in the measurement of lease liability and the right of use the asset. Next is reassessment arising from a change in amount expected to be payable under a residual value guarantee. Okay, underline residual value guarantee. Now here we will not use a different discount rate. The lease liability should be remeasured by discounting the revised lease payment including reflecting change in residual value guarantee using an unchanged discount rate. Unless the change in residual value guarantee, again see exception to that, unless the change in residual value guarantee results from a change in floating interest rate, in which case the lessee should use a revised discount rate that reflects the change in the interest rate. If residual value changes, use the same discount rate. But exception, if the residual value changes due to change in floating interest rate, that means the calculation may be linked with floating interest rate. In that case, we will use a revised discount rate here also. Remeasurement arising from change in future lease payment resulting from change in an index or a rate, including a change to reflect changes in market rental rates following a market rent review. Now the change is due to index, rate or market review. The lease liability should be remeasured to reflect those revised lease payment only when there is a change in the cash flow. If because of this, if there is a change in cash flow, then revise the lease liability. Okay, that is when the adjustment to lease payment takes effect. If due to change in index, rate or rent review, your future cash flow changes, then revise the lease liability. Okay, the revised lease payment for the remainder of the lease term should be determined using the revised contractual payment, and they should be discounted using an unchanged discount rate. Same discount rate we will use, because here the change in cash flow is due to something which is external like index or rate or market rent. Unless the change in lease payment, again exception, is as a result from a change in floating interest rate, in which case the lessee should use a revised discount rate that reflects the change in the interest rate. After some time you will get confused. Okay, so what you will do as a homework summary. If the change is due to change in lease term, revised discount rate. Change is due to change in purchase option, revised discount rate. Change is due to index, rate, market rent review, same discount rate, unless the cash flow changes because of floating interest rate. if the change in guaranteed residual value takes place, old rate only, unless the residual value changes due to change in floating interest rate. Now we'll solve one small case study after the break.